Hello, and welcome to our presentation on staying the course during volatile markets. My name is Rick Chase. I'm a Regional Client Services Manager with the Colorado Retirement Association. We know uncertainty can be scary as we are truly living in unprecedented times. World markets have been severely impacted, with stocks down an average of 20 to 30% from the beginning of the year as COVID-19 spreads across the globe. This has created uncertainties about aspects of our daily lives and what the future may hold. For those of you invested in the stock market, the increased volatility over the past several months, and especially the last few weeks, and its impact on your retirement savings may be causing you anxiety. You are not alone. In 2020, we have all witnessed the dramatic swings of the market, including the largest single-day point drop since Black Monday in 1987, followed by the biggest single-day point gain in the history of the market. When markets get rocky, it can be extremely tempting to get your investments out of the market to avoid further loss. While that is a completely natural response, remember, it is emotionally based. History teaches us that having a personalized plan and staying the course is often the best course of action. This webinar is going to discuss strategies, provide insight on additional things to consider, and present a long-term perspective that explores opportunity. So what is causing the current market volatility? The uncertainty associated with the global spread of the COVID-19 virus and the world government's varying responses to it are what is causing the current market volatility. Unlike the recession of 2008, the current economic upheaval we are seeing is the result of an event that is external to or outside of the economy itself, much like a natural disaster. The effect on businesses that have been impacted by the COVID-19 virus and the various attempts to slow its spread have been economically devastating. Whole industries such as hospitality and travel have been shut down. Previously healthy sectors of the economy, such as energy and materials, have been badly damaged, resulting in layoffs and a sharp increase in unemployment claims. Global supply chains are being disrupted, one region after another, creating a ripple effect of shortages and delays of manufacturing parts and components that are essential to today's interconnected world economy. Concerns about when the economy will be ready to reboot and uncertainty about the current and future impact of the virus have taken their toll on the world markets. As fear and panic set in, some investors are reacting emotionally as they try to avoid further losses, which in turn adds to the volatility of the market. Schools across the United States and in other parts of the world have closed either temporarily or for the remainder of the year, leaving school-aged children at home until August and September. Stay-at-home orders have been put in place in many areas, keeping employees away from their jobs for weeks at a time. A portion of the population has the ability to telecommute or work remotely, while many others have lost their ability to earn a paycheck altogether. Let's take a look at how the response of the U.S. federal government is also playing a role in the current market volatility. World governments have enacted a multitude of new measures in an attempt to slow the spread of the virus. The U.S. federal government has provided emergency funding to fight the pandemic and declared a national state of emergency to unlock additional financial relief for impacted Americans. Interest rates were reduced to nearly zero, and the Federal Reserve made large purchases of U.S. government securities. Congress recently passed a $2 trillion stimulus package to provide financial support to taxpayers, small businesses, and corporations, while also expanding unemployment benefits. The market has reacted to the federal government's response favorably, resulting in 3 straight days of large gains for investors, including the largest single-day gain in the history of the stock market. With all of these ups and downs, you may be wondering what you can do to weather the storm. Instead of trying to time the market or react emotionally to short-term uncertainty, try to focus on creating a suitable investment plan based upon your personal time horizon and risk tolerance, and then stay the course. Market declines are a natural part of the economic cycle. By investing regularly, you can take advantage of down markets by buying shares while prices are low. Having a diversified portfolio can help reduce the effects of market volatility by not overexposing you to any one asset class. Remember, nobody will ring a bell to tell you the market has hit the bottom. Having a long-term roadmap can help you to reduce risk, remove short-term uncertainty, and weather periods of market volatility. The Colorado Retirement Association has an online investment learning center and many other resources to assist you in creating a personalized plan. As we mentioned earlier, when markets get rocky, it can be extremely tempting to pull your investments out of the market to avoid further losses. Keep in mind, when you move your investments out of the stock market, you essentially lock in any current losses, and you may miss the best, most impactful days of the upcoming market. You might be thinking, how big of an impact could it possibly have if I miss a week or two while I try to stop my losses? The impact to the rate of return on your investments can be much, much bigger than you imagine. The effect of missing the 5 best days in the market over the last 20 years would have dropped your return by 35%, while missing the 10 best days of the market would have cut your return by more than 50%, and it doesn't get any better after that. By remaining in the market, you can be invested on the best days, whenever they occur, and take advantage of dollar cost averaging as the market shifts over time. Dollar cost averaging helps to eliminate risk associated with correctly guessing when to get into the market. Dollar cost averaging uses a strategy of spreading out your stock or fund purchases at regular intervals and in roughly equal amounts, instead of purchasing your stock all at once in a lump sum at a particular price. When done properly, it can have significant benefits to your portfolio. This is because dollar cost averaging smooths your purchase price over time and helps ensure that you're not dumping all of your money in at a high point for prices. Dollar cost averaging can be especially powerful in a bear market where prices have fallen 20% or more from recent highs, allowing you to buy the dips or purchase stock at low points when most investors are too afraid to buy. Committing to this strategy means you will be investing when the market or stock is down, and that's when investors score the best deals. Dollar cost averaging does not guarantee a higher rate of return, but has been shown to help reduce cost per share while also minimizing risk. Current market volatility may present an opportunity for long-term investors. You are automatically taking advantage of dollar cost averaging by making systematic contributions to your CRA retirement plans. Asset allocation is an investment strategy that seeks to maximize investment returns while minimizing market risk. One step you can take to reduce your risk to the impact of the market volatility on your investment portfolio is to allocate your assets across different asset classes in more than one market segment. This strategy is called diversification. For example, you may purchase a variety of stocks and bonds representing various segments of the market. While one segment may be experiencing a downturn, another could be growing. Therefore, you may be able to offset losses in one segment with gains or smaller losses in another segment. Asset allocation allows you to own a variety of investments that react differently to the same market events. The amount you allocate to each asset class can change over time and takes into account your risk tolerance, your goals, and the length of time you have to invest before needing income in retirement. Reacting emotionally and trying to time the market often leads to behaviors where we sell low and buy high, which can lower your overall return and also risk that you may miss the best days of the market. The importance of having the appropriate asset allocation is most evident during volatile markets. When determining how to allocate your assets, you'll want to consider how long you will be investing and how much risk you're willing to tolerate. The length of time you will be investing is known as your time horizon. Consider this. If you have plenty of time before your planned retirement age, you may feel comfortable creating a more aggressive portfolio that, while typically characterized by high growth potential, could be subject to greater short-term fluctuations. This allows long-term investors to take advantage of the market volatility by buying when prices are low. However, if you are nearing retirement, you may want to consider a more conservative portfolio. You may need access to your money sooner and therefore won't want to be exposed to potential market drops in the short term. Personal risk tolerance is defined as how much uncertainty you're willing to accept in exchange for the potential of higher future returns. Has the recent uncertainty and market volatility had you worried about the way you're invested, and are you allocated properly? If so, an option to consider is an auto-allocated target retirement portfolio. The Colorado Retirement Association offers target retirement portfolios as an investment option. Target date portfolios are intended to provide participants with auto-allocated investments based upon a future retirement date. They provide professional oversight to ensure balanced risk by diversifying your assets across many different types of investments, and they rebalance automatically. The goal of rebalancing is to improve long-term returns and reduce undesired market volatility. CRA's target date portfolios are automatically rebalanced. If you've created your own diversified investment portfolio, you also have the option to rebalance your investments by logging into your account and selecting View/Manage My Investments. These investment options offer simplicity and peace of mind. You may view the target date portfolio options by visiting craonline.org and clicking on the Your Plans link at the top of the page. You should consider conducting an annual wellness check that includes assessing your asset allocation and possibly rebalancing your portfolio. If you're invested in our target date portfolios, then your asset allocation will automatically change over time, becoming more conservative as you get closer to retirement. By conducting an annual wellness check, you can help ensure that you are on the right track, ready to weather the market volatility, and prepared to stay the course. If you need more help, we are here for you. We know that it can be frightening when financial markets are up and down. You may feel strong temptation to take action to stop the losses, but most often it's best to stay the course. A careful assessment of your individual risk tolerance, years to retirement, and investment allocation can help assure that you are well positioned for long-term retirement savings, regardless of temporary periods of market uncertainty. While it may be difficult to remain calm during a substantial market decline, it is important to remember that volatility is a normal part of investing. Additionally, for long-term investors, reacting emotionally to volatile markets may be more detrimental to portfolio performance than the drawdown itself. If you still feel anxious or unsettled about your current investments or about the market overall, you can review your account online at cra.online.org or visit with us by calling 1-800-352-0313. Be safe, be kind, and thank you for watching.